Hello everyone, welcome to Global Online. In this lecture, we are going to see NTA UGC NET Paper 2 Commerce 2022 batch, and this is a complete revision of Accounting and Auditing unit, that is unit number 2 under Commerce syllabus. And this is one of the most important unit from the exam point of view. So do watch this lecture to clear all your doubt. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1 in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7,000 rupees only. Whenever we are studying unit 2, that is accounting and auditing, the first question is what is accounting? To understand this unit thoroughly, you have to understand what is accounting first. So accounting has a rightly been termed as a language of the business. The American Institute of Certified Public Accountant has defined the financial accounting, the art of recording, classifying and summarizing in a significant manner and in terms of a money transaction and the event which in part at least of the financial character and interpreting the result thereof. So here accounting is a language, the language we use for the communication. This is a language we use in the business to value the business. So here the accounting, in accounting we are doing the recording, classifying and summarizing. Recording of the transaction, any transaction which are happening in the business, we are recording that, we are classifying that and then we are summarizing that. And after all this we are getting the value for any business, that is called the accounting. Then is bookkeeping. Understand the meaning of a bookkeeping. Bookkeeping is a part of the accounting. Here what we say, it is a part of the accounting and it is a concern with the recording of the transaction which is often routine and clerical in the nature. Imagine this is the whole is the accounting. So here this part will be the bookkeeping. Here we consider the bookkeeping is a part of the whole accounting, okay, because in the bookkeeping we are only recording the transaction which are happening in the business, okay, but in accounting we are recording, we are classifying, we are summarizing. So all about other work we are doing in the accounting and not in the bookkeeping. Bookkeeping is a maintained only to record the transaction. Accounting as a science. A science is a systematic body of knowledge. It establishes a relationship of cause and effect in the various related phenomena. Like same, we consider the accounting as a science. Now why we consider the accounting as a science? Because the accounting has also its own principle. In accounting, we say that every single transaction has a two effect. One will be the debit and another one will be the credit. Okay. Means whenever we are buying something or whenever we are selling something, every transaction will be having a debit effect and will also having a credit effect. Okay, that's why we are saying the accounting as a science. The second point here is accounting as a arts. The arts require a perfect knowledge, interest and the experience to do the work effectively. Accounting also requires the knowledge, interest and the experience to maintain the books of the account in a systematic manner. Anybody can't do the accounting. If I want to do the accounting, but if I'm having no knowledge of the accounting, I can't do the accounting. That means the accounting require the knowledge, interest and the experience. That's why we're considering the accounting as a arts. Another important point here is the accounting equation. Accounting equation is a relationship between the assets, liability and the owner's equity. Here the owner's equity means the capital. Okay. So first equation here is the assets equal to liability plus the owner capital equity or a capital. And the second equation is owner's equity equal to assets minus liability. Please by heart this equation. Okay. You receive the question on this equation. So the total of the asset will be equal to the total of liability plus the owner's capital, because all the assets of a business are claimed by the either the owner or a outsider. Okay. Then is accounting concepts. The term concept is used to connote the accounting postulates, that is necessary assumption and idea which are fundamental to the accounting practice. The concept means the assumption or an idea which we are going to use in the accounting practice. In other words, the fundamental accounting concept are a broad general assumption which underline the periodic financial statement of the business enterprise. The examples of the accounting concept are business entity concept is there, money measurement concept is there, going concern, matching concept, then is a dual concept, cost concept. All these concepts we are going to see further. The another point here is accounting convention. Now why we are using the conventions? It is used to signify the custom or the tradition as a guide to the preparation of the accounting statement. Okay. Now what different things are included in the accounting convention? Then it include a convention of materiality, conservatism and the consistency, which we are going to see in detail further. Under accounting principle, there is a accounting concept and the accounting convention. Under the accounting concept, there is a money measurement concept, business entity concept, going concern concept, cost concept, dual aspect concept, accounting period concept, matching concept and accrual concept. And under the convention, there is a consistency, conservatism and materiality. The first concept here is separate business entity concept. In accounting, we make a distinction between the business and the owner. All the book of the account record the day-to-day financial transaction from the viewpoint of the business rather than from the owner. In the accounting, we always consider the business and the owner as a separate entity. For example, if I am doing a business, I am the owner, so me and my business will be considered as a separate entity. Okay, whatever I am buying for my own self will be not recorded in my business. Okay, and whatever we are buying for the business, I am buying for my business will be recorded under the business transactions. Okay, so here we are considering the business and the owner is a separate entity. For instance, when a person invests rupees 1 lakh into the business, it is treated that the business has brought that money from the owner and it will be shown as the capital in the books of account of the business. That is called a business entity concept. The another important concept here is money measurement concept. Now what money measurement concept says, in accounting only those business transactions are recorded which can be expressed in terms of the money. Opposite to that, the fact or a transaction or a happening which cannot be expressed in terms of money cannot be recorded in the books of the account. Okay. Now the money measurement concept is having a two limitation. First one is you cannot record those important things which cannot be expressed in the monetary term, like the general health condition of the managing director of the company. Now why we cannot record the health condition of the managing director of the company? Because we cannot express the health condition of the managing director in the term of the monetary form, and because of that we cannot record this. Secondly, the use of a money implies that we assume the stable or a constant value of the rupee. Okay, so this is called a money measurement concept. The simple thing is that only those transactions are recorded which can be expressed in terms of the money. Then is dual aspect concept. Financial accounting record all the transaction and the event involve the financial element. Each of such a transaction require the two aspect to be recorded. The recognition of this two aspect of every transaction is known as a dual aspect analysis. According to this concept, every business transaction has a dual effect. So here we are saying that every transaction is having a two effect. Okay. Whatever we are buying or whatever we are selling will have a two effect. One effect will be the debit effect and another effect will be the credit effect. That means our transaction is having a two effect, and because of that we are considering the dual aspect concept here. For example, if a firm sells the good of rupees 10,000, this transaction involves the two aspects. One aspect is delivery of the good and the other aspect is a immediate receipt of the cash. In fact, the term double entry bookkeeping as a came into the existence because of every transaction of the entries are made. Okay, means that every transaction is having a two effect, and because of this we are considering this concept. Then is going concern concept. Accounting assumes that business entity will continue to operate for a long time in the future unless there is a good evidence to the contrary. The enterprise is viewed as a going concern, that is, as a continuing in the operation at least in the foreseeable future. Here we are considering whatever business we are doing, we will do for the long time. It is a going concern concept. We will operate that for the long time. We will not shut down our business, correct? In other terms, there is neither the intention and nor the necessity to liquidate or to shut down the particular business in a predictable future. Because of this assumption, the accountant, while valuing the asset, do not take into the account the sale value of them. So here the business is a going concern concept. Then is accounting period concept. With the name of this concept, you might understand that we are talking about the accounting period. If we are running the business, what will be the accounting period for this business? Okay, this concept requires that the life of a business should be divided into the appropriate segment of studying the financial result shown by the enterprise after each segment. A year is the most common interval for the account of prevailing the practice, tradition and the government requirement. Some firms adopt the financial year of the government, some others the calendar year. Okay. Now, what is the accounting period? Accounting period is a time when we are valuing our business, right? That is April to March. That is the accounting period. Then is a cost concept. According to this concept, an asset is a orderly enter on the accounting record at a price paid to acquire it. Okay. For example, if a business buy a plant of rupees 5 lakh, the asset will be recorded in the book of at rupees 5 lakh, even if the market value at that time happened to rupees 6 lakh. The cost concept does not mean that all the assets remain on the accounting record at their original cost for all the time to the claim. The asset may systematically be reduced in its value by charging the depreciation. Okay, means whatever cost we are buying the asset, we will record that amount in our book. Now, if for example, if I buy the plant for rupees 5 lakh, but the value of the plant increases and the market value becomes the 6 lakh, but I have purchased that plant for rupees 5 lakh, so I will record the 5 lakh and not the 6 lakh. Okay, it might be the market value of that plant, but the amount for which I have purchased, I will record that amount in the books of account. There is a matching concept. This concept is based on the accounting period concept. In the reality, we match the revenue and the expenses during the accounting period. So according to this matching concept, we are comparing the revenue and the expenses. We are matching our revenue with the expenses. How much we have earned and how much we are spending, that we are matching with each other. Okay. So here we are matching the revenue and expenses during the accounting period. Then is accrual concept. Accrual concept is the most fundamental principle of the accounting, which require the recording revenue when they are earned and not when they are received in the cash, and the recording expenses when they are incurred and not when they are paid. For example, a business record its utility bills as soon as it's received them and not when they are paid. Because the services has been already used, the company ignore the date when the payment will be made. Okay. Then we are talking about a convention. First one is materiality convention. Materiality concept state that the item of a small signifies need not to be given a strict theoretically correct treatment. For example, the ordinary calculator costing rupees 100 maybe last for the 10 year. Supposing we are buying the calculator of rupees 100. Okay. Now here, however, the efforts involved in collecting its cost over a 10-year period is not worth benefit, then can be derived from this operation. The cost incurred on the calculator may be treated as the expenses, because this 100 rupees we cannot be calculated for the 10 year, because it's just 100 rupees. So we are treating this 100 rupees as a expenses for that particular period in which it is a purchase. Okay. It should be noted that the item material for one party may be immaterial for the another. It is a matter of the judgment. In materiality convention, we are saying that it's a matter of the judgment and the common sense, how that person or how that accountant is recording that particular item. Okay. Then is conservatism convention. According to this convention, the revenue or the gain should be recognized only when they are realized in the form of cash or the asset, that is a debt. The ultimate cash realization of each can be assess with the reasonable certainty. Okay. Here what we are saying here, the revenue or the gain should be recognized only when it realized in the form of the cash, only when we are getting the particular cash. The provision must be made for all known liabilities, expenses or a loss. For example, it include the valuing of the stock in the trade at the market price or the cost price, whichever is the less, and making the provision for the doubtful debt on the debtors in the anticipation of the actual bad debt. Last one here is consistency convention. The convention of consistency requires that once a firm decides to certain accounting policy and a method and has used this for some time, it should be continue to follow the same method for the or a procedure for all the subsequent similar event and the transaction, unless it has a second reason to do otherwise. Okay. What this convention is saying, if the business is following a particular method to do the accounting, the business have to follow the same method for the long period of the time. Okay. For example, if the depreciation is a charge on the fixed asset according to the straight line method, this method should be used or followed year after year. We cannot change the accounting method which we are using according to this convention. Okay. So this is again the most important topic under this unit, that is accounting standard or a Indian accounting standard. So here what you have to do is you have to remember the name and the Indian accounting standard number. Okay, that is Indian accounting standard 1. You have to remember the name, that is presentation of financial statement. Then is accounting standard 2, that is inventories. Like this you have to remember all these standards only because there is 100% question on this accounting standard. You may receive the question in the match the following type question or the fill in the blanks question. So please remember all the accounting standard. Try to by heart this. So now let's understand what is partnership. Partnership is defined in Section 4 of Indian Partnership Act 1932 as the relationship between the person who have agreed to share the profit of the business carried on by all or any of them acting for the all. Here the partnership is defined under Section 4. Please remember the section and the act, that is a 1932. Okay. The partnership means the relationship between the two persons. It is an agreement between the two or more people where they are agreeing to share the profit, where they are doing a business together, and on this they are making the agreement to share the profit and loss for the business. Okay, that is called a partnership. There is a partnership deed. A contract for a partnership need not necessarily be in the writing, although it is advisable to reduce it in the writing to minimize the dispute among the partners. Okay, it is not necessarily or it is not compulsory that it should be in written format, but it is advisable. Why it is advisable? To minimize the dispute among the partners. Okay, but when the contract is put in the black and the white, the written contract is called a partnership deed. It is a legal document signed by all the partners. Okay, when we are making a contract on the paper, means when we are writing the contract with the black pen on the white paper, that is a written document, and that paper, that agreement is called a partnership deed, and we consider it is a legal document which is signed by all the partners whoever are involved in that partnership. Okay, it is a mostly content with the name of the partner, name of the firm, nature of the business to be carried on by the firm, the power of the partner, when the termination is certain, the term of the duration of the partnership, the amount of a capital to be contributed by each partner, the restriction on the working capital of the each partner, the method of the division of the profit and the loss, how they are going to share the profit and the loss, how much will be the salary, how much will be the commission, interest payable to the partners, interest on the drawing to be charged on the withdrawal, interest on the loan payable to the partner, valuation of the goodwill when there is a change in the constitution of the firm, the method of the accounting and the attribution clause. Okay, all these things will be included in the partnership deed. Okay, means the name of the partnership, the firm, how much the ratio they are going to share, how the profit is going to be distributed among the partners, how will be the interest. Okay, all these things will be there in the partnership deed. Then is a reconstitution of the partnership. Now what is a reconstitution? When there is any change in the existing agreement of the partnership, it is a reconstitution of the partnership. Means whenever we are making any change in the previous agreement which we are having with ourselves, that time we are saying that it is a reconstitution of the partnership. As a result of a reconstitution, the existing agreement of a partnership comes to the end and a new agreement is the formed. Whenever we are making some changes to the previous agreement, that time that agreement comes to the end and we are forming the new agreement. There might be several reasons for the reconstitution of the partnership firm. The first reason is the change in the profit sharing ratio. The profit sharing ratio is a ratio where the partners are sharing the profit with themselves. That ratio is called a profit sharing ratio. Whenever we are making a changes in the profit sharing ratio, that time the reconstitution of a partnership can be happen. The second reason is admission of the new partner. Admission of the new partner means that whenever the new person is getting admitted into the partnership, okay, that time the reconstruction of a partnership can be happen. That is a retirement of the partners. Now why the person is getting retired? Maybe because of the age, maybe because of the health condition. that time the reconstitution of the partnership can be happen. And last reason is death of the partner. If somebody die because of the accident or maybe because of the some other reason, that time the reconstitution of a partnership can be happen. So please here remember these reasons, because in exam you might receive the question on this. The another important topic here is sacrificing ratio. Please understand this because you might receive the practical question on this topic. Okay. In partnership business, when the partner is admitted into the firm, the old partner have to surrender a portion of their share of the profit in favors of a new partner. Whenever the new person is getting admitted, whenever the new person want to come into the partnership, that time the old partners who are there in the partnership have to surrender some portion of their share of the profit, because the new partner will also get the same amount of the profit, right? And because of that, the old partner have to surrender some portion of their shares of the profit. Sacrificing ratio is the difference between the old profit ratio, sharing ratio, and the new profit sharing ratio of the old partners. Okay. Here we will see the example of sacrificing ratio. The example is if the A and B share the profit in the ratio of 5:3 respectively, and the admission of the C, the new ratio among the A, B, C is agreed upon 7:5:4 respectively, the ratio of a sacrifice will be calculated as the follow, for which we have to see how much A is sacrificing. For this, the formula is sacrifice by A equal to A's old share minus A's new share. The old share of the A is 5 divided by A, 8, and the new share is 7 by 16. So here we have to make a denominator same. For this, we are multiplying the 5 multiplied by 2 and 8 multiplied by 2. The answer is 10 divided by 16. So when we minus 10 from 7 from 10, we are getting 3. That means the sacrifice ratio of the A is 3 by 16. Then we see the sacrifice by B. Old share minus the new share, that is 3 by 8 minus 5 by 16. We are getting 1 by 16. Hence the sacrifice ratio of A and B will be 3:1. Then is the gaining ratio. On the retirement of the partner, the share of the profit to the other partners increase. Okay. Whenever the person is getting retired, his share will be distributed among the old partner. That means the old partners, whoever are there in the partnership, will get the more shares of the profit. In order to find out the ratio in which the remaining partner have a gain, the old share should be deducted from the new share of the remaining partners. We will see this with the example. Here the example of gaining ratio. If the A, B, C share the profit and the loss in the ratio of 7:5:3 respectively, and after the B's retirement, A and C decided to share the profit and the loss in the ratio of 3:2 respectively, then the ratio of the gain will be calculated as the follow. We have to see how much the A old share is, that is 7 divided by 15, and A's new share is 3 divided by 5. The gain whatever the A is getting is new share minus old share, that means 9 minus 7 divided by 15. The new share or a gain, whatever the A is getting is 2 divided by 15. Then is C. His old share is 3 divided by 15 and his new share is 2 divided by 5. The gain whatever C is getting is new share minus the old share, that means 6 minus 3. The gain whatever C is getting is 3 divided by 15. That means the ratio or a gain between the A and C is 2:3 respectively. This is the gaining ratio. Then is a memorandum revaluation account. What it means? A new partner is not being benefited by any appreciation in the value of an asset of the firm or by any decrease in the value of a liability of the firm. Therefore, before a new partner is admitted, the assets and the liability of the firm are revalued, and any profit or a loss resulting from such a revaluation is transferred to the old partner's capital account in the old profit sharing ratio. What it means? Before we admitted a new partner into the partnership, we are doing a revaluation of the assets and the liability, whatever are there in our business. Now, why we are doing this? So that any partner who is getting admitted will not get any benefit if there is a appreciation or an increase in the value of the assets of the firm. Okay, or will not suffer because of the decrease in the value of the liability of the firm. Whatever the profit or the loss we are getting from the revaluation of the assets and the liability, we will share that loss or the profit amongst the old partner in the old profit sharing ratio. That is called a memorandum revaluation of the account, which we are doing before we are admitting a new partner into the partnership. Dissolution of the firm. Dissolution of the firm means that the business of the firm is put to the end. The assets are disposed of and the liability are paid off, and the account of all the partners are settled. In the dissolution, the firm is going to be a wind up. Okay, means the shutdown. So all the assets whichever are there are disposed of, the liabilities are paid off, and the account of all the partners, whoever partners are there in the partnership, their account will be settled. Then is the dissolution of the partnership. A partnership is dissolved on the expiry of the term or on the completion of the specific venture, death, retirement, or the insolvency of the partner. When the partnership is getting wind up or when the partnership is getting to the end, when there is a expiry of the term, whatever the agreement we have made is getting over, or on the completion of the specific venture, or on the death, if somebody die, means the partner die, then it can be a dissolution of the partnership or the retirement or the insolvency of the partner. However, if the remaining partners decide to continue to run the business, the partnership is not dissolved. If somebody die or somebody retire, but still whoever are there in the partnership, they decided to continue to run the business, then the partnership of the firm will not dissolve. Okay, they can continue. If they do not continue, then the firm is also dissolved automatically. If the partnership is getting over, if the partners decided to wind up, then the firm will also dissolve automatically because there will be a no partner, right? So that means the firm will not remain in the existence. The one of the most important topic under this unit is a depreciation, because from this topic you might receive the question during your exam time. So here the depreciation is the process of allocating the cost of the fixed asset over its estimate useful life in the rational and the systematic manner. Okay, the business enterprise acquire a different type of a fixed asset. To do a business, the businessman will acquire a different types of the fixed asset, right? To run a business, the businessman require the different type of a asset which he will take from the market or he will buy from the market. Whenever the asset is used in the business, its a value get reduced, and sooner or later the assets become useless. For example, if you buy a car for your personal use, and the cost of the car is rupees 10 lakh. for this year. Can the value of the car will remain the same for the next year? Then the answer will be no. Because after we use that car, the value of the car will reduce because we already used that car, right? Depreciation is a permanent, continuous and gradual in the book value of the fixed asset. The one of the important method under the depreciation is the fixed installment method or a straight line method. Under this method, the fixed portion of the original cost of the asset is written off every year. You have to remember the formula here. The depreciation equal to the original cost of the fixed asset minus the estimated scrap value divided by the life of the asset in the number of the year. Now how we can find out the percentage of the depreciation? Then the formula is depreciation multiplied by 100 divided by original cost of the fixed asset. Please by heart this formula. Diminishing balance method or reducing balance method. Under this method, the depreciation is calculated at a certain percentage each year on the balance of the asset which is brought forward from the previous year. The amount of a depreciation charge for each year is not fixed, but it goes on the decreasing gradually as the opening balance of the asset in the each year will reduce. Supposing this year we are reducing the 10% depreciation. So next year it might be a 8%. Okay. Every year it is decreasing. 10, 8, like 6% next year. Like this. Okay. For this the formula is depreciation equal to 1 minus square root net residual value divided by cost of acquisition. The rate of depreciation equal to 1 minus n. Now here the n is life of the asset in the years, the number of years. Sum of years digits method. In this method, the charge for depreciation on the accounting period is calculated in the portion of remaining life of the asset at the beginning of the every accounting period. Depreciation goes on decreasing every year. Okay. For this the formula is depreciation equal to remaining life of the asset including current year multiplied by cost of the asset divided by sum of the digit of the life of the asset in the years. Then is share capital of the company. Here, a company, form of a business organization, is a voluntary association of a person to carry on a business. Now, what is a business? Business is a voluntary association of the person who carry out the business, who carry out the organization. Okay, here are so many people are coming together with the one intention to start a new business. Okay, or start a new organization. It is an association of a person who generally contribute money for the same common purpose. So people who decided to start a business now will contribute the money, will contribute the capital to start a business. To start any business, to start any organization, we require money, right? So here what they are doing, they are collecting money from every person, and they will contribute that money to start a business. The money so contributed is the capital of the company. In business, whatever money the person are contributing, we are saying that is the capital of the company, and this total share capital is divided into the number of a unit, and this is known as a share. Imagine this is a total capital of the company, and now this total capital which is contributed by the different person will be divided into the number of the unit, and this number of a unit will be known as the shares of the company, and this shares is now will be given to the general public to collect the more money for the company. So here the company is issuing these shares for collection of the money. Equity shares capital. Here the equity shares are the main source of the finance of the firm. Now to start a business, we require the finance, we require money. The people who decided to start a business will contribute their money, but that money are not enough to start a business. So from where company will collect the money? And for this the company will issue the shares. Okay, and here the equity shares are the main source of the finance. It is issued to the general public. Okay, equity shareholder enjoy the right to control the affairs of the business, and all the shareholders collectively are the owners of the company. Here you might receive the question on this sentence that equity shares are the owners of the company. Okay, they do not enjoy any preferential right with regard to the repayment of the capital and the dividend. Nominal or authorized capital. It refers to that amount which is stated in the memorandum of the association as a share capital of the company. So here the authorized capital is the amount which we have already stated in the memorandum of the association as a shares capital of the company. The company will have a memorandum of association, and in that memorandum of association, company have already referred this amount, and this amount is called the authorized capital. The company is registered with this amount of the capital. This is a maximum limit of the capital which a company is authorized to issue without amending its memorandum of the association. So whatever amount we are recording in the memorandum of association, that is a maximum limit for the company to authorize to the issue without amending its memorandum of the association. Issued capital. It refers to the part of authorized capital of the company which has actually been offered to the public for the subscription in cash, and the shares allocated to the vendor promoters for the consideration other than the cash. Okay, issued capital is referred to the part of the authorized capital of the company. Now the authorized capital is the amount which we register in the memorandum of the association. Okay, and this capital is offered to the public for what? For the subscription. It will be in a cash, and the shares will be allocated to the vendors and the promoters for the consideration other than the cash. It is a set the limit of the capital available for the subscription. Securities premium. The shares of many successful companies which offer the attractive rate of a dividend on their existing capital fetch a higher price than their face value in the market. There are so many companies which are working or which are there in the market, right? And this company offer the attractive rate of a dividend. Here the dividend means the interest which we are getting after we buy the shares. Okay. So here what the company is doing, they are charging the higher price for their shares above the face value. Now the face value means the original value of that particular share which is there in the market. When the shares are issued at the price higher than the face value, they are said to be issued at the premium. Okay. Now here, whenever the company is issuing the shares at a higher price than the face value, than the original value, that time we are saying it is issued at the premium, and thus the excess of issue price over the face value is the amount of the premium. For example, if a share of rupees 10 is the original value or the face value, is issued at rupees 12, then the 12 minus 10, here the rupees 2 will be the premium amount. Okay, here the value of the shares is 10, we are issuing at a 12, that means the extra amount, the excess amount which we are charging will be the premium, means rupees 2 will be the premium here. This is the security of the securities premium. Then is forfeiture of shares. If the shareholder fail to pay the allotment money or the call made on him, his shares are liable to the forfeited. Okay. If the company shareholder who are there, if their shareholders is failed to pay the allotted money, then his shares are liable to the forfeited. The forfeiture of the shares may be said to be a compulsory termination of the membership by way of the penalty for a non-payment of the allotment and or any call money. Okay. The effect of the forfeiture of the share is that defaulting shareholder lost all his right in the shares and ceased to be a member. The name of a shareholder is removed from the register of the members and the amount already paid by him is the forfeited. Here the forfeiture is the cancellation. It is a compulsory termination of the membership by way of the penalty. Here the company will charge a penalty for the non-payment of the allotment and the call money. And this creates the effect on the shareholder that all his right will be taken from him and his name will be removed from the register of the member and the amount already paid by him will be the forfeited. Then is the preference shares. Preference shares are commonly known as preferred stock. Are those shares that enable the shareholder to receive the dividend announced by the company before receiving to the equity shareholder. Means before equity shareholder, they cannot receive the dividend. They cannot receive the interest on their shares. Then is debentures. Now what is debentures? The debentures is against the marketable security which is issued by the business or the organization. The debenture are an important source for a long-term borrowing of the company. It is again the source of the finance, the long-term source of the finance from where the company can collect the finance. The procedure for issuing the debenture by the company is very much similar to that of issue of the shares. The procedures is similar to the issue of the shares. The how we are issuing the shares, in the same way we will issue the debenture, but it is for the longer period. Another important topic here is amalgamation. In an amalgamation, two or more companies are combined into the one by a merger or by a one taking over the other. Here the two or more companies are coming together and they are deciding to combine into the one, maybe by the merger or by one taking over the other. And therefore the term amalgamation contemplates the two kinds of activity. The first activity is two or more companies join to form the new company, and the second one is the absorption and the blending of a one by the other. Thus the amalgamation includes the absorption. With regard to the amalgamation, the Accounting Standard 14, the Institute of Chartered Accountants of India has introduced the Accounting Standard 14, that is AS 14, which is accounting for amalgamation. And this question you receive in the Match the Following, where they are giving you the accounting standards and they will be asking you the name of that accounting standard. So please remember this, the Accounting Standard 14 is with regard to the accounting for the amalgamation. Then is vendor and vendee companies. A company going to liquidation or a merge the companies are called a vendor company or a transferor company. The company who want to get a liquidated, who want to get a end up or a merge with the other companies, that time we are saying the vendor companies or the transferor companies. The new company which is a form to take over the liquidated company or the company with which the transferor company is a merge is called a transferee or the vendee. Okay. In case of amalgamation, the assets and the liability of the transferor companies are amalgamated and the transferee company become the vested with all such assets and liabilities. Here in case of the amalgamation where the assets and the liability of the transferor company is getting the amalgamated and the transferee company is becoming the vested with all the assets and liability, that you have to remember here. Liquidation of the companies. The liquidation is the legal procedure by which a company comes to the end. Thus the company, being a creation of a law, cannot die in a nature. The company, when found necessary, can be liquidated. Liquidation is the winding up when the company is doing a legal procedure to end up the organization. The winding up of the company or a liquidation of the company is the process by which a company assets are collected and sold in order to pay all the debt, where the people who are working in the company, the owner of the company, will decide to sold off all the assets and pay all the debt whichever are there. The another important concept here is management accounting. Now the management accounting is a presentation of accounting information in order to formulate the policy to adopt by the management and assist its day-to-day activities. Okay. So here the management accounting is the presentation of what? About the accounting information. Now why we are doing the presentation of accounting information? In order to formulate a policy which the management can adopt to assist the day-to-day activities in the business. Okay. The scope of management accounting is broader than the scope of cost accountancy. Here you have to remember this sentence. Okay. Now look here, what are the different elements of the cost? The cost can be mainly divided into the material, labor and other expenses. When we see the element of the cost, we see the materials, labors and the expenses. Now this material is again divided into direct material and indirect material. Labor is again divided into direct labor and the indirect labor, and the expenses again divided into the direct expenses and indirect expenses. The direct material, direct labor and the direct expenses, when we add three together, we get the prime cost. Okay. And when we add indirect material, indirect labor and indirect expenses, we get the overhead. Okay. Please study this diagram. Please remember what different things are coming under the element of the cost and how they are again getting divided. Then is cost unit. Cost unit is a device for the purpose of breaking up or separating the cost into the smaller subdivision attributable to the product or the services. It is a unit of a quantity of the product, service of a time or a combination of those in relation to which the cost may be ascertained or expressed. The simple meaning is that the entire cost what the business is having is divided into the separate unit. We are dividing the total cost into the smaller subdivision. Okay. That is called a cost unit. The example of a cost unit are industry product and the cost unit, the automobile, the number of vehicle. How we are dividing the automobile? Then is a number of the vehicle. Then is a cable, meter or a kilometers. Cement in ton. Chemical or a fertilizer, maybe in the liter, kilogram and the ton. Okay. Then is the cost control. Now here we have to understand the meaning of the cost control. Cost control is also known as the cost management and cost containment. Please remember the another name for the cost control, that is a cost management and cost containment. It is a both set of a cost accounting method and a management technique with the common goal of improving the business cost efficiency by reducing the cost or at least restricting the rate of the growth. The common aim, the common goal of the cost control, why we are doing the cost control, why we are managing the cost, because to improve the cost efficiency, because to reduce the cost, whatever cost we are getting from the business, we want to reduce that, because no one want to spend a high amount in the business, right? They want to control the cost, and because of that we are using the cost management technique where we are trying to control the cost, we are trying to restrict the rate of the growth of the cost. Okay, the business use the cost control method to monitor, evaluate and ultimately enhance the efficiency of the specific area, such as a department, divisions or a product line within their operation. Then is the cost reduction. Cost reduction may be defined as a real and a permanent reduction in the unit cost of good manufacture or a service render without impairing their suitability for the use intended. Here we are trying to reduce the cost, whatever we are spending, we are trying to control that, we are trying to reduce that. It may be a real or a permanent reduction in the unit of a cost of a good manufacture and a service render. There is the production or a manufacturing cost. Now you know the what is meaning of the production. Here the production is the process where we are trying to convert the raw material into the final product. Okay, we are trying to convert the raw material. Okay, we are making the product, final product. Okay, that this process is called a production. Production cost is the cost of all the item involved in the production of the product and the services. This refers to the cost of operating manufacturer division of the undertaking and involve all the cost incurred by the factory from the receipt of the raw material and the supply of the labor and the services until the production is completed and the finished product is packed with the primary packing. Here we are considering all the cost whatever we are getting in the production process, from the raw material whatever we purchase till the final product packed in the primary packaging. Okay, whatever cost involved there, we are considering all this cost. The example of this cost will be a direct material, direct labor, direct expenses, factory overhead are considered as a production or a manufacturing cost. There is the administration cost. Administration within the management. Administration of the management. So here the administration costs are the expenses incurred for a general management of the organization. To manage the organization there will be a administration cost. Now what are this administration cost? What we can include here, that we will see. These are the nature of a indirect cost and also the term as a administration overhead. The example of a administration cost are salaries of a office staff, accountant, director, rent, rate, depreciation of a office building, postage, stationery and telephone, office supplies and the expenses. Whatever expenses we are incurring in the administration cost means the whatever salary we are giving, the rent, the television cost, electricity bill, all these things will be included in the administration cost. The next one is selling and distribution cost. Now our product is ready, right? Now we have to sell the product. To sell the product, again there will be a cost which we have to incur. We have to appoint a salesman, or we have to arrange the transport to sell that final product. Okay. From the manufacturing unit, we have to take that product to the final market, for which again the transport expenses will be there. So all these things will be included under the selling and the distribution cost. Here the selling costs are a indirect costs related to the selling of the product, are a services, and include all the indirect costs in the sale management for the organization. Distribution costs are incurred to make the saleable good available in the hand of the customer. Okay. Now we want our product to be sold, to be distributed to the final customer. Okay. And this cost is called a distribution cost. The example of a selling and a distribution cost are the salary and a commission of the salesman and the sales manager, expenses of the advertisement. To sell our product, we will do the advertisement, right? Again, to do the advertisement, there will be some expenses. So these expenses we are including in the selling and the distribution cost. There is a maintenance of the delivery van. It will be also included in the selling and the distribution cost. Then is the fixed cost. Fixed cost is the cost which does not vary with the change in the value of a activity in the short run. These costs are not affected by a temporary fluctuation in the activity of the enterprise. These are also known as period cost. For example, rent, depreciation. When we are talking about a fixed cost, the word only say it is a fixed. It will not get fluctuated. It will not get changed with the small changes or with the temporary fluctuation in the activity of the enterprise or the activity of the business. Okay, it is a fixed in nature. Opposite to that, there is a variable cost which will get the vary, which will change. The variable cost is the cost of the element which tend to directly vary with the value of activity. Variable cost has a two part, that is a variable direct cost and variable indirect cost. Okay, here you have to remember this, that variable cost is again divided into two part, that is a variable direct cost and a variable indirect cost. The variable indirect costs are termed as the variable overhead. For example, direct labor or a outward freight. Then is a semi-variable cost. Semi-variable cost contain both fixed and a variable element. They are partly affected by the fluctuation in the level of the activity. These are partly fixed and partly the variable cost and vice versa. For example, factory supervision, maintenance. So here the semi-variable cost, when we are talking about a semi-variable cost, we are talking about the fixed and a variable element both together. It is partly affected by the fluctuation in the level of the activity. Okay, and the semi-variable cost is a partly a fixed and a partly variable cost. So this we have to remember here. Then is opportunity cost. Opportunity cost is a value of alternative foregone by the adopting a particular strategy or employing the resources in the specific manner. It is a return accepted from the investment other than the present one. For example, if the fixed deposits in the bank are proposed to be a withdrawal from a financing project, the opportunity cost will be the loss of interest on the deposit. Means if we have invested in the fixed deposit, okay, now on that fixed deposit there might be some amount of the interest which will be which we will get after some year, right? But now I want to withdraw that for some financial project. Okay, now I have to invest that amount in some project, and for this I am withdrawing that amount from the bank. Now here I am losing the interest amount which I might get after some years, right? So here I am losing the opportunity cost. Then is a sunk cost. Sunk costs are a historical cost which are incurred. That is a sum in the past and are not relevant to the particular decision making problem being considered. While considering the replacement of the plant, the depreciation book value of the old asset is irrelevant as the amount is a sunk cost. Sunk cost is a historical cost, the past cost which is incurred in the past. Okay, and this sunk cost is not relevant while making a particular decision in the business. But while considering the replacement of the plant or the depreciation of the book value of the old asset which we have purchased in the past, it is irrelevant as the amount is the sunk cost. Okay, then remember that the sunk cost means the historical cost, the past cost. Then is a process costing. When the production process is such that goods are purchased from the sequence of continuous or a repetitive operation or a process, the cost incurred during the period is considered as the process cost. Okay. Now here the process costing is employed in the industries where the continuous process of manufacturing is carried out, where we are continuously doing the or manufacturing the product. Okay, our process are continuously going on. For example of this process costing is a chemical industry, maybe a gas or electricity generating concern, maybe a quoted as an example of undertaking that employed process costing. Process costing in a simple word is the process, whatever cost we are incurring during the process of manufacturing the final product, that is called the process costing. Ratio analysis, it is a relationship between the two accounting figure and this is known as the ratio. If we find out the ratio, we find we are dealing with the numbers, right? Ratio analysis is a process of comparison of one figure with the another. What we are doing here, we are comparing the one figure with the another figure. It helps to make a proper analysis about the strength and the weakness of the firm's operation. The calculation of a ratio are a relatively easy and a simple task, but a proper analysis and a interpretation of the ratio is an important task here. Okay. So here the what ratio analysis is doing, it helps the company, it helps the organization to find out the strength and the weakness of the organization, the operation, how the organization is going, right? And the calculation of the ratio is a easy or a simple task, but doing an analysis, doing an interpretation of that ratio is again the important task. Ratio analysis is a very powerful analytical tool useful for measuring the performance of the organization. It is extremely helpful in providing the valuable insight on the company's financial picture. Here we consider the ratio analysis is a very powerful or a very important analytical tool because it helps us in measuring the performance of the organization, and based on this analysis the organization take a further step. Then is the classification of the ratio. When we see the classification of the ratio, that time we are talking about a liquidity ratio, leverage ratio, activity ratio and a profitability ratio. Here the liquidity ratio is they measure the firm ability to meet the current obligation. Second is a leverage ratio. This ratio shows the proper proportion of the debt and the equity, how much debt is there and how much equity is there in the financing the firm's asset. Then is activity ratio, they reflect the firm efficiency and utilization the asset. And last one is the profitability ratio. This ratio measure overall performance and the effectiveness of the firm, how the organization is performing and how much it is effective, that we are looking in the profitability ratio. Current ratio. The ideal current ratio is taken as 2:1. Please remember this. Okay, you have to remember this figure 2:1. This ratio measures the short-term solvency of the company. What this current ratio is doing? Current ratio is measuring the short-term solvency of any company or the organization. Current asset are the asset which can be converted into the cash within the 1 year, and the current liability are the liability that are payable within the 1 year. So what is important here is when we are talking about a current ratio, here the current asset will be converted within the 1 year. Same applies to the current liability. The liability should be payable within the 1 year. Okay. The formula for the current ratio is current ratio equal to current asset divided by current liability. Please by heart this formula. The another important formula here is liquid ratio or the quick ratio or the acid test ratio. The ideal liquid ratio is taken as 1:1. Please remember this. The liquid asset will include the cash in hand, cash at bank, sundry debtors, excluding a bad debt and readily marketable security. So what does liquid asset is including, that you have to remember, because to find out the liquid asset you have to use this. Okay, you have to add all these things and you have to minus the bad debt and the readily marketable security. The prepaid expenses and the stock are not taken into the liquid asset. The whatever prepaid expenses are there of the organization and the stock, the inventories will be not included in the liquid asset. Here the liquid ratio equal to liquid asset divided by the current liability. Sometimes they will ask you to find out the liquid asset, and to find out a liquid asset you have to remember what is included in the liquid asset. Okay. Debt equity ratio. The debt equity ratio is used to ascertain the soundness of the long-term financial policy of the business. The main purpose of the ratio is to determine the relative stake of outsider and shareholders. Now, why this debt equity ratio is used? Is used to ascertain the soundness of the long-term financial policies of the organization. And the purpose of this debt equity ratio is to determine the relative stake of the outsider and the shareholder. Shareholder is a person who has taken the company's shares. The debt equity ratio equal to long-term debt divided by equity or total liability divided by shareholder funds. We use this formula to find out the debt equity ratio. Then is capital gearing ratio. It is an important ratio. Gearing should be kept in such a way that a company is able to maintain a steady rate of the dividend. Dividend is what? Dividend is the interest which is given to the shareholders. High gearing ratio is not good for a new company or a company for which the future earnings are uncertain. Okay. So now how we are getting this capital gearing ratio? For this, there is a formula, that is fixed income or a dividend bearing fund divided by equity shareholders fund. Now to find out the fixed income bearing fund, there is again formula for which we have to take a debenture plus long term loans plus the preference shares capital. We will get the fixed income bearing fund. And to find out the equity shareholder funds, we have to take a equity shares capital plus reserves and surplus minus debit balance of profit and loss account minus fictitious assets. Proprietary ratio. It expresses the relationship between the net worth and the total asset. What exactly this ratio is doing? This ratio is expressing the relationship between what? Between the net worth and the total asset, which we have to remember here. The high proprietary ratio is indicative of strong financial position of the business. Higher the proprietary ratio, stronger will be the position of the business. Okay, and the higher ratio is a better for the organization, better for the firm. So here the proprietary ratio equal to proprietary fund divided by the total asset is the formula to find out the proprietary ratio. Proprietary fund equal to equity share capital plus preference shares capital plus reserves, and we have to minus the fictitious assets. And total asset is a fixed asset plus the current asset. Excluding the fictitious asset means we don't have to add the fictitious assets here. Then is interest coverage ratio. The interest coverage ratio show how many times the interest charge are covered by the fund and are available for the payment of the interest. A very high ratio indicates that a firm is conservative in using the debt, and very low ratio indicate the excessive use of the debt. This is called the interest coverage ratio. And to find out the interest coverage ratio, you have to know the formula. For this, the formula is earning before interest and taxes, that is EBIT divided by interest expenses. You will get the interest coverage ratio. Then is the debt service coverage ratio, that is DSCR. Don't get confused if you receive this DSCR. So DSCR means the debt service coverage ratio is a ratio which is often looked into by a bank when they evaluate the credit proposal. Each bank has a benchmark DSCR below which they get the little requirement to grant a loan to the company. Okay. So this ratio is used by the bank and not the company, and the formula for this is net operating income divided by total debt services. Total debt services cover both the interest and installments. Then there is a gross profit ratio. The ratio measures the gross profit margin on the total net sale made by the company, and it is calculated based on the formula, that is gross profit divided by sales multiplied by 100. You will get the gross profit ratio. Okay. Then is a net profit ratio. This ratio measures the efficiency of the operation of the company. So why we are using this ratio? We are using this ratio to measure the efficiency of the operation of the company. The net profit is arrived at from the gross profit after deducting the administration, selling and the distribution expenses. The ratio is calculated like net profit ratio equal to net after tax, that is PAT divided by sales multiplied by 100. Then is the return on the investment. When we say return on the investment, means the amount which we are getting after investing some amount in some project. Okay. This ratio shows how much company is earning on its investment, that is the capital employed. Whenever the company is investing in some project, the company in return will get some amount as a investment amount, that is return on the investment. This ratio reflects the overall efficiency with which the capital is used. The return on the investment is an important measure of the profitability and is useful for inter-firm comparison. The return on the investment can be calculated by operating profit divided by capital employed multiplied by 100. Then there is a return on the investment. The profitability of the firm is a measure by establishing the relationship of a net profit with the total asset of the organization. Now here we are looking at the relationship between the net profit of the company with the total asset of the company or the organization. And this ratio indicates the efficiency of the utilization of an asset in generating the revenue. Revenue means the income for the business. So here the return on the investment equal to profit after tax divided by net asset of the company multiplied by 100. You will get the return on the assets. Then is earning per share, that is EPS. This ratio is calculated to judge the overall profitability of the organization. So the EPS, that is a earning per share, is calculated to judge the overall profitability. How much the profit the organization is getting. Okay. The ratio measures the profit available for the earning per share. The ratio measures the profit available for the equity shareholder on per share basis. Okay. So here this ratio is available, or this ratio measures the how much the dividend, how much the interest available for the equity shareholder. Okay. Now here the equity shareholder are the person who has buy the shares from the company. The equity shares of the company, they are called the equity shareholder. Okay. The equity shareholder on a per share basis is calculated from this ratio. Now here the earning per shares equal to profit available for equity shareholder divided by the number of shares. Then is price earning ratio. So here this ratio measures the number of time the earning of the last year at which the share price of the company is quoted. Price earning ratio is the barometer of the market sentiment. The higher the price earning ratio reflect the higher earning potential, and low profit earning ratio reflect the lower earning potential. Okay. So basically this ratio is measuring the number of time the earning from the last year, okay, the past year, at which the share price of the company is quoted. Here we are looking at the share price which is quoted by the company during the previous year, during the past year. Okay. The higher the price earning ratio will reflect the higher earning potential, but the low price earning ratio reflect the lower earning potential. Here the price earning ratio equal to market price divided by EPS, that is earning per share. Then is a stock turnover ratio. This ratio measures how many times a company inventory has been sold during the year. If the inventory turnover ratio is low, it means either the inventory is growing or the sales are dropping. Okay. Here we are measuring how many times the company has since the inventory is being sold during that particular year, the stock has been sold during the particular year, and if the inventory turnover ratio is low, if this ratio is low, that means either that inventory is growing or the sale is dropping, the sale is going down. The stock turnover ratio equal to cost of goods sold divided by average stock. Now how we find out the average stock? To find out the average stock, there is again the formula. The average stock equal to opening stock plus the closing stock divided by 2. Then is working capital turnover ratio. This ratio indicates the extent of a working capital turnover in achieving the sales of the firm. To find out a working capital turnover ratio, we have a formula, that is sales minus working capital. We will get the working capital turnover ratio. Then is the debt ratio. The debt ratio refers to the ratio of a long-term debt to the total of external and internal fund, that is capital employed or a net asset. It is computed as the debt ratio equal to long-term debt or a capital employed. Then is the auditing. Here the auditing is a systematic examination of the books and the record of the business or the organization in order to ascertain or verify and to report upon the fact regarding the financial operation and the result thereof. Here we consider the auditing as a systematic examination of what? Of the books and the record of the business or the organization. Whatever the organization has done, we have to verify this, and to verify this the company appoints the auditor and who will do the auditing of the company. The main objective of our auditing is to help the auditor to form an opinion as a whether the books of our account and the financial statement show the true and the fair view of the business. The subsidiary object of the auditing is to detect and prevent the error and the fraud in the books of the event. So here the auditor will be appointed to do the auditing and he will provide his opinion. He will give his opinion on the books of the account or a financial statement. Whether that book of account and a financial statement show the true and the fair view of the business. Whether it is a correct or a not. And the auditor will deduct and prevent the error and the fraud in the books of account if it is there. Okay. Then is auditing standard, a new standard to issue by the AASB. Now what is the full form of AASB? Then it is Auditing and Assurance Standard Board, henceforth are collectively known as Engagement Standard. Okay, remember this word, that is Engagement Standard, and comprises of first one is Standard on Auditing, that is SA. Then is Standard on Review Engagement, that is SRE. Third one is Standard on Assurance Engagement, that is SAE. And last one is Standard on Related Services, that is SRS. Please remember this or by heart this, because you might receive the question in the paper. There might be a question like recognize which one is the auditing standard. You might get the auditing and accounting standard mixed in the question, and they might tell you to tell which are the auditing standard. So please remember this. Then is internal audit versus statutory audit. Now what is internal audit? Internal means within the organization. The word itself says that it is internal, means inside. Okay, internal audit is the arrangement within the organization to verify on continuous basis the correctness and the truthfulness of the transaction by the salaried staff. Okay, internal audit is within the organization, and who will do this audit? The auditor of the company will do this audit. Then a statutory audit is the examination of the books of account of the business by an external auditor. Okay, who is doing this statutory audit? Then is an external auditor, and the report that of a profit and loss account and a balance sheet are drawn according to the provision of the law, and a financial statement reveal the true and fair view of the result of the operation and the financial state of affairs of the business. Okay, what different things has to be covered in audit? That is principal aspect to be covered in the audit. Now it will be the internal control system, review of the system and the procedure, accounting principle. What different principles are there which we have to see in the audit? Then is the books and the statement, verification of the asset. What different assets are there? Verification of the liability, the truth and the fair view, statutory compliance and the report. Benefits of the audit. Satisfaction of the owner. The owner will get the satisfaction after doing an audit. Then is a deduction and a prevention of the error and the fraud. If there is an error, if there is a fraud, that can be found out while doing an audit. Verification of the books of the account. The auditor will verify the books of the accounts. Independent opinion, he will give his independent opinion. Okay, there is a moral check, protection of the rights and the interests of the shareholder, ensure the compliance with the legal requirement, straighten internal control system, and reliance by the outsiders. So these are the different benefits which the organization will get after doing a audit. Then is the limitation of the audit. Audit involve the higher cost. Yes, to do the audit, it requires a higher cost because the organization, the businessmen have to hire the auditor who will do the audit, and for this require the higher cost, right? Because the organization have to pay to the auditor. Audit involves reasonable length of the time. Again, the auditor will take a time. The length of the time is required to do the audit, to do the verification of all the things. Based on the test check, evidence obtained by the auditor are persuasive rather than the conclusive. Auditor cannot determine the appropriateness of an accounting estimate because of the uncertainties involved in it, and the audit is based on the information provided by the management. The audit, whatever the auditor is doing, is based on the information provided by the management. Okay, he cannot do his own thing. He have to give his opinion on the base of whatever information he is having. So it is based on the information provided by the organization or the management. Then is a secretarial audit. Secretarial audit is a compliance audit, and it is a part of the total compliance management in the organization. Please remember this, that a secretarial audit is a part of the total compliance management in an organization of the company. Secretarial in a practice has been assigned the role of secretarial auditor under section 2 clause 2 clause C clause V of the Companies Secretaries Act 1980. Please remember the section here and the act, that is a 1980. Then is a cost audit. The Institute of Cost and the Work Accountant of India is defined the cost audit as a system of the audit introduced by the Government of India for the review, examination and appraisal of the cost accounting record and attend the information required to be maintained by a specific industry. Now, why this audit is introduced by the Government of India? To review, examination, the appraisal of the cost accounting record and the attendance information which is required to be maintained by the specific industry. Okay, the cost audit is useful for the purpose of the cost control, cost reduction and a proper utilization of scarce resources. Okay, now why this cost audit is required, why it is useful? So that the company can control the cost, okay, which is unnecessary, cost reduction and a proper utilization of scarce resources, the resources which are scarce which we can utilize properly. Section 148 of a Companies Act 2013 contain the provision regarding the cost audit and contain that cost audit, whenever conducted, is in addition to the statutory audit conducted under Section 143. Okay. Then is a tax audit. In India, the Income Tax Act 1961, Section 44AB provide for the compulsory audit of the account of a certain income tax assessee whose turnover or a receipt exceeds the specific limit. Okay, there is a limit for the turnover or a receipt. Okay, so it is a compulsory audit of the account of certain income tax assessee. Okay. The objective of such an audit is to assist the tax authority in making the correct income assessment of the assessee concerned. The tax auditor has to specify the report on a certain transaction which have an effect on the income tax liability of the assessee concerned and are thus important to the tax authority. This is called a tax audit. Here what you have to remember is the Act of the Income Tax and a section. The another important audit is a management audit. Management audit is a emerging concept of the auditing. Now here the management audit is an act of evaluation of all the activity of all the department with a view to provide the appropriate suggestion to the management to help their work. So here what is management audit? Management audit means the evaluation of all the activity which is going on in the organization, the activity of all the department with a view to provide the appropriate suggestions. The main objective of the management audit is to improve the profit earning capacity, work of the management, objective of a program, social objective and human resources development so that the organization goal can be easily attained. Here what is the main aim or a main objective of a management audit is to improve the profit earning capacity of the organization, can improve the work of the management, social objective can be improved, the human resources development can be improved so that the organization can easily achieve their target, can easily achieve their goal. This is the main objective of management audit. Then is vouching and verification. Please understand this. Vouching is a process of checking the vouchers related to the transaction recorded in the books of the account by the auditor himself or by his assistant or by an audit clerk. So here the vouching means what? Vouching means the process of checking the vouchers. Whatever vouchers are there in the organization, that will checked by the auditor or his assistant or the audit clerk. Vouching means to vouch, to examine the vouchers. On the other hand, the verifications means to verify the assets and the liability of the business. Okay. As a simple word, verification, we understand that it means to verify whatever things are there, whatever things are happening in the organization, we will verify that. We will verify the assets and the liability of the business. Both the two terms are a first two step of the auditing. In fact, the vouching help in process of the verification. Audit report. Under section 143 clause 2 of Indian Companies Act 2013, the auditor shall make a report to the member of a company on the account examined by him and on every financial statement which are required by or under this act to be laid before the company in a general meeting, and a report shall, after taking into the account the provision of this act, the auditor who is doing an audit have to make a report on whatever he has been examining. Okay, and that report has to be submitted by the auditor to the company before the general meeting. Okay. Then is unqualified opinion in the audit report. When the unqualified opinion in the audit report is submitted by the auditor, when the auditor do not have any reservation or any objection regarding the information provided by the organization under the audit, and then he issue an unqualified opinion. Okay, this opinion signifies that auditor accept the accounting treatment given to the various transactions and a profit and loss account show the true and a fair view of the transaction entered into the organization during the period, and a balance sheet show the true and a fair view of the state affair of the organization at that point of a time. This report is also known as the clean report. Please remember the another name, that is a clean report. Adverse or a negative opinion and in a audit report. When the auditor will provide this, if the result of the examination of the books of the account, the auditor conclude that he does not agree with the true and a fair view of the financial statement under the audit, he expressed the adverse opinion, negative opinion. Okay, where the auditor expressed the adverse opinion, He should also state his report the reason for the same so that the reader can assess their significance and effect. Here what the auditor is doing, here the auditor is not agreed with the audit, with the whatever the organization is doing, that is the report is not a true or a fair. Okay, so what he is doing, he is giving the adverse opinion, he is giving the negative opinion. Then is qualified opinion. In this situation where neither the unqualified nor the adverse opinion is appropriate, the auditor will give the qualified opinion. In this situation where the auditor has some reservation about a financial statement with though the significant but not a significant, so that to warrant the adverse opinion, and the auditor is agree to a large extent with the truth and the fair view of the financial statement, then he will give a qualified opinion. As per this, the opinion subject to the certain reservation or a qualification stated, the auditor agree with the proposition stated in the financial statement. There is an energy audit. Energy audit is related to the energy which is used by the organization. Energy audit is defined as the verification, monitoring and analysis the use of energy, including the submission of a technical report containing the recommendation for improving the energy efficiency with the cost benefit analysis and the action plan to reduce the energy consumption. Okay, and this given under the Energy Conservation Act 2001. Please remember this act and the year. The functions of the energy auditor could be compared with that of a financial auditor. At the moment, while energy auditor is not yet a mandatory requirement on all the India basis. So this is not a mandatory. The financial auditor is a prerequisite for any organization. Energy auditor is normally accepted to give a recommendation on the efficiency improvement leading to the monetary benefit and also advise on the energy management issue. Then is an environmental audit. It is related to the environment. The objective of an environmental audit are to evaluate the efficacy of the utilization of resources of a man, machine and a material, and to identify the area of environmental risk and liability and the weaknesses of the management system and the problem in a compliance of the directive of the regulatory agency and control the generation of the pollutant or a waste. Okay, whatever the organization is doing should not harm our environment. Okay, there should be a limit. We shall not pollute our environment. Okay, or we shall not throw the waste in the outside so that we can't harm the environment. Then the safety audit. Safety audit is related to the safety which is provided in the organization. Safety audit is a planned, independent, documented and systematically approach of determining the success level of a health and a safety management system. Okay, it involves the collection of data, analyzing it and result compared with the organization health and a safety objective and a organizational best practice. So basically it is about the health and the safety which is provided within the management or within the organization, which we are going to see in the safety audit.